Alright, boys, so this is how I made $15,000 trading options, meta options specifically, when I was 18. I think I said that already, but back in, when was this, 3 years ago, 2022. I stopped trading meta, but might get back into it. But this is how I made 15 grand in like a week trading options for meta. And it's all about supply and demand. Keep it simple, nothing too crazy. Back in then, I didn't really do anything crazy, nothing like that. It was just demand zones like this. So basically, what you want to do, like I've talked over my videos, is there's always a candlestick that stands out, right? Like this one right here. It wicked out from here. It was basically like a liquidity sweep, and it rose up, which means there's significant people buying here. There's a significant amount of people. So what I used to do is I would go up to higher time frame, for instance the daily chart, 24 hours, and I would see where we were standing at. For instance, here on the day of April 8th, we rose up, and then we also had maybe like a breakup structure here, and then a retracement back into the demand zone, which right here would have been the perfect opportunity to get in on the 21st. Price was around 480, and you could have bought it 2 weeks out, and now it's at $660. So as you can see, it's all about where people want to buy. Realistically, this doesn't mean nothing to me. Like it does mean something. It just, like I'm talking about like the all the ICT stuff that they're teaching nowadays. Not to say none of them work, but you want to keep it simple. I feel like all these, you want to keep it simple. All these people, or all these market movers, they already have complex algorithms that are helping you. They're not to take money from you. They're to help you get money. You gotta look at it at a different perspective. Algorithms they use past data to move price, so why can't you just move like them? And this even does work on shorter time frame. Obviously, if you go down the 5-minute chart, you can see what's going on. Okay, we worked here, shot up again, and supposedly we broke through. Okay, cool. So let me get this out the way. Where would there be a supply or demand zone here specifically? Well, here we had this candle for a huge move down. So you would want to mark it from the bottom level up until its top wick. If you go down to the 1-minute chart, you can see that it didn't even wick out. It was a good opportunity. And how I would take this would have been like this. A stop would have been right here, and then I would have targeted this significant low down here, and obviously the risk reward would have been a 15.5, for instance, right here. You always want to take it to a significant higher or a significant low. Market bounces, and there's a really good YouTuber that I watch. I just started watching him, but he explained it very well. I noticed this pattern for some time now, but what he calls it is like a supply channel. So basically there's obviously some sort of supply here. Okay, that's the wrong one. Okay, I'll just use these. Supply here, right? And then there's another channel which would have been obviously it's not always going to be perfect, the supply. Like for instance, this candle, it never even reached up here, but you can see whenever something like that happens, what you can take into account is the floor, I like to call it, wherever the largest supply candle closed at. So you go from there and then go to the top of there before the sell off, and it usually does work. And for instance here, see here, this would have been the demand candle, and we did get a bounce. That would have been a good trade. You would just probably got in wherever it closed, taking it to the next significant level where we fell off. The risk reward would have been a 5.1. That's not bad. So it's all demand, all supply. It's all you want to realistically do. Obviously, if you do swing trading, it works, just as well. But obviously, we do have, all these gaps. Sometimes the gaps do suck, but whenever that happens, I would just switch the Heikin-Ashi candles, and you can see significant levels. For instance, the move up, I would just use this candle right here is very significant. It wicks out all of them. Then you just take it back, and you can see it came down. Usually, the better the trade is one that does not surpass 0.5 from half of that range. So using the Heikin-Ashi candle, you want to take the trade a little bit. You want it to get bounce above 0.5. But for instance, I would have gotten right here, somewhere right here, wherever I could have got in, and the reward would have been here. So if it does go under 0.5, maybe it's not really gonna go bounce, and it's just gonna continue lower. Then I would have targeted a significant high or low. And for instance, me personally, I would have just targeted this right here, and the risk reward would have been 1.64, which isn't the best. This trade, it can work, but sometimes, it's an edge. It's not always gonna be perfect. It's another good. How can I show y'all? For instance, here. Let me switch over to Heikin-Ashi. Oh wow, it just moved me. I think it was right here. You can see here, this is obviously the previous candle for the move down. You can see here. Where was it at? Here. Okay, I guess it disappeared. For instance, if you're on the 1 minute chart, you can see right here how it obliterated 0.5, went higher, then it came down, then it came back up again. It started using it as demand. And same thing here, didn't really reject. It was sort of just super choppy. Wouldn't have been, it wouldn't have been a great trade. Up until, we came up here, and then we tested these actual new supply zones. It's like price is always going to react at a certain place. But I'll show you. Price is always going to react. It's always going to react. Say there's a supply zone there. It's going to create a new channel. Boom. And let's say it goes here. There's some little tiny demand. And then we go here. And then we go lower. It's going to create a new supply chain. It might not go all the way up here again. You can go here. You can go here. Or you can get here. Like, each time is going to be different. If that makes sense. I don't know if I explained that pretty good. But it's like we have a zone here. Or it'll be a little bit more, obviously, down. Then you have a new zone here. And then I was like, oh, okay, maybe we have a new zone here. And then boom. So it's just a channel of going down, down. It's not always going to look perfect because it's stock market. But that's basically how you can use a basic strategy. Make you some bread. For instance, here as well, you can just use a significant one with a wick. Go from here. Go for here, and you can see, boom, it went down, boom, boom. Then there's nothing too crazy to it, nothing complex, nothing that's too difficult. Just have an edge, and tight, not a tight stop loss, but just one that makes sense. You don't want to have the tightest stop loss. But personally, for me, I think this is good enough. It's like, if it's already rejecting from here, why not, get in again? So this would have been a risk reward of, however much you wanted. For instance, for me, obviously, the significant low would have been down here, but you want to keep it simple. This was in the morning. I think it was, yeah, it was in the morning, so you probably wouldn't be in and out. Still risk the reward would have been 6.15. So for every $100, you would have made $600. So that's still pretty good. That's how I did it. Nothing too complex. I'm starting to get back into this style of trading instead of doing all this complex stuff.